We're looking at a report and podcast script that's diving into the recent surge in NBIS stock.
The 10% plus pop, yeah.
Exactly. It details the AI infrastructure deals with Meta and Microsoft and makes a pretty bold forecast that the stock is poised to hit $160.
A very topical piece. Let's get into it.
Okay, first thing, the overall tone of the report needs some careful calibration. We think it's important to ensure the high-energy opening doesn't undermine the analytical weight that you need later on.
Right.
The material opens with a very high-energy hook. It uses these powerful market phrases, the stock absolutely ripped. It's the next major runner.
Which is smart commercially. It grabs your attention.
It does, but it sets up this friction point. You get this high-stakes excitement, and then it transitions into very detailed financials and that, aggressive 160 forecast.
And that's the core tension we spotted. The language used in the opening and also in the conclusion describing the move as an explosion, it works to get attention, but it creates this jarring disconnect.
A disconnect with what?
With the really serious data you present, you're talking about a $119.6 million net loss, or the fact that the stock's trading at a steep 73 times PE ratio.
I see.
That mismatch can make a sophisticated listener, the kind of person you're targeting, feel the whole thing is a bit
Promotional?
less like a sound analysis.
Exactly. Not as critically sound as it actually is. So the suggestion for improvement here is that while you maintain that urgency, you really need to anchor the language more closely to the financial significance of the move.
And the institutional validation?
Right. Rely on that rather than just the emotional hype. That should ensure a smoother transition into your financial deep dive segment.
Think about who you're talking to. An investor who understands a 73 times PE isn't really moved by the word explosion.
They need something else.
They need a prompt that signals a major structural shift is happening. A really actionable way to do this is just to rethink the segment titles.
Okay, like what?
Well, instead of the forecast, next stop $160, which, sounds a bit like a trading floor bulletin.
A bit salesy?
Yeah. You could try something like modeling the $160 consensus, quantifying the valuation re-rating. It just signals precision and rigor right away.
And that rigor needs to be carried all the way through to the end. We notice the outro, the bottom line segment, kind of reverts to calling it a generic, high-risk, high-reward play.
Which is such a lost opportunity.
A complete throwaway line.
Right. Instead of that generalization, the outro has to reinforce your analytical findings. You should emphasize the report's specific conclusion.
Which is that $160 is a logical valuation re-rating.
But only if those specific financial conditions are met. Flawless execution without burning through cash too quickly. Your final words need to solidify the argument, not, dilute it with market cheerleading.
That framing shift alone adds a huge amount of credibility.
Instantly.
Okay, moving on to our second major observation. The material correctly highlights the core catalyst here.
The pivot.
The pivot. NBIS is effectively pivoting from its legacy as Yandex into a pure-play AI infrastructure powerhouse, a neocloud. And this is credited with that huge 355% revenue increase.
Yeah, that pivot is the narrative engine for the whole piece. It's a fascinating story. A major geopolitical shift creating this focused, high-growth AI company.
So to establish that competitive credibility and really strengthen the narrative, the crucial transformation from NBIS's legacy as Yandex needs to be integrated more explicitly. It should be a foundational advantage, not just a historical note.
That's it. Because right now, the weakness is that the listener is kind of left to assume why.
Why this transformation suddenly positions them to win these massive deals.
Exactly. Why can they instantly secure multi-billion-dollar contracts with hyperscalers like Microsoft and Meta? The jump from, a legacy tech conglomerate to neocloud is just too swift.
There's a missing piece.
The narrative lacks specificity on what proprietary assets or expertise they actually retain from Yandex that's enabling all this sudden success.
It's a credibility gap. I mean, Meta and Microsoft aren't signing these huge supply contracts with a generic startup.
No way. They are validating a serious high-end infrastructure capability that has to come from somewhere.
So the suggestion is to briefly weave in the specific technological capabilities or operational continuity that lets this new neo-cloud identity compete right away. That would justify the speed and the scale of these partnerships.
You need to see the DNA of Yandex in the NeoCloud offering.
What does that mean in practice?
Well, what did they actually build? Did they have proprietary network routing IP that drastically lowers latency? Did they keep the core engineering teams who are specialized in optimizing these huge data centers?
Or maybe existing assets, like fiber or power distribution.
Right, things that let them bypass the time-to-market hurdles that their competitors face.
That's how you make the history relevant to the 160 valuation today. So in the Catalyst section, you could connect that historical capability directly to the current tech.
For instance, explain that the reason they can so efficiently provision high-end NVIDIA GPUs is because they inherited Yandex's deep expertise in distributed computing.
Which competitors can't just replicate overnight.
Exactly. And when you talk about the Meta deal, where a hyperscaler just buys out your entire capacity, you have to make a clearer link between that validation and the tech platform they inherited.
Meta is buying expertise, not just hardware.
Yes, and specifying what that expertise is gives so much gravity to the valuation argument. It shows the company is standing on decades of work, not just, optimism.
Okay, that makes sense. That fully integrates the corporate background into the financial story. Let's turn to the financial core, which is maybe the trickiest part to get right. The report bravely identifies a key risk. NBIS is losing money, a net income loss of almost $120 million.
Because they're spending heavily on CapEx, buying chips, building servers.
And the justification given is that Wall Street currently rewards revenue growth and future capacity.
Which is a common market truism, but for a piece that's aiming for high-level insight, it's just not enough.
So the analysis of that net loss and heavy CapEx needs a more explicit analytical framework. It has to connect the company's $4.8 billion cash position directly to the investment required for these huge long-term contracts.
The weakness here is really clear. The risk is identified, but the material relies on that generalized justification, Wall Street rewards growth, without quantifying the specific financial pressure points.
The numbers are just staggering. I mean, the sheer scale of that estimated $17 billion Microsoft deal implies CapEx requirements that just dwarf their current cash position.
It absolutely does. We're talking about maybe needing 3 or 4 times their current cash reserves to fully service a contract like that.
Exactly. So if I'm a skeptical institutional investor, I see a $4.8 billion cash pool facing commitments that could total $20 billion or more.
The question becomes, how do you maintain liquidity? How do you service that commitment? The report is, well, it's silent on the mechanism.
So the suggestion is to structure a brief analytical moment where you juxtapose the limits of that cash position against the required CapEx.
And in doing that, you clarify how the market is tolerating the high PE ratio and the current losses.
This is where the analysis can really show its depth. You could introduce a challenging question right in the financial deep dive segment.
Like what?
Something like, is the connection between the existing cash position and the required future investment fully established, or is that a major area for investor due diligence?
I like that you acknowledge the hurdle instead of just smoothing over it.
And then you pivot to solve it.
Yes. Then you detail the actual financial levers they can pull. The market tolerates this disparity because it expects the company to use things like vendor financing or strategic debt facilities or
Staged payments.
staged CapEx payments, linked to revenue milestones in the contracts themselves. The report needs to say that the $17 billion deal isn't a single cash outlay. It's a commitment that's serviced by structured financing. That's how they manage the burn.
That is the missing link. You use the liquidity risk as a springboard to discuss the timeline for these massive revenue contracts to actually invert the cash burn rate.
Right.
If the report can outline that, say, the cash burn should slow down by Q3 of next year because revenue from the Meta deal starts coming in, then the $160 valuation suddenly has a tangible financial timeline.
And that projection, the path to becoming cash flow positive, that is what grounds the 73 times valuation in reality.
It transforms the analysis.
It really does. It goes from just identifying a risk to demonstrating a sophisticated understanding of how these high-growth, infrastructure-heavy businesses actually finance these gargantuan deals. It makes the entire forecast far more robust.
That definitely strengthens the fundamental argument for the $160 target. If that path to managing the cash burn is clear, the target moves from being optimistic to being, modeled and validated.
And it addresses the single biggest question that a highly skeptical, high-level investor is going to have when they look at that balance sheet.
So this gives us 3 very actionable steps to really maximize the credibility and impact here. First, refining the tone.
Right.
Elevate the analytical substance over the market hype.
Second, deepen the narrative around that corporate pivot from Yandex to NeoCloud.
You have to spell out what historical technical assets or expertise give them that competitive edge to win those massive contracts right out of the gate.
And finally, provide a more robust analytical framework for the CapEx and liquidity demands. Model how that $4.8 billion in cash actually relates to those future obligations.
By discussing the financing mechanisms and that timeline to invert the cash burn. Implementing these adjustments will ensure that the audience fully trusts the rigor that's supporting that impressive $160 forecast.
The core material here is fantastic. These steps are just about maximizing its persuasive power and its analytical depth.
We encourage you to implement these suggestions and submit the revised work back to us for a final critique.
We'd love to see it.
Until then, keep refining.